Every second in India, thousands of megawatts of electricity are consumed by factories, metros, data centers, hospitals, and homes. Nearly 70% of that electricity still comes from coal. Behind this energy flow stands a private power giant with over 15,000 megawatts of installed capacity, the largest private thermal power producer in India. Its plants operate round the clock. Revenues depends on long-term power purchase agreements, merchant tariff, coal supply chains, and regulatory approvals. One tariff order can affect the profitability. One fuel disruption can alter the margins. This is capital intensive, regulation driven infrastructure closely tied to the India's industrial growth. There are signals that this company's potential entry into the nuclear power generation, a tightly regulated sector requiring enormous capital and long gestation. If executed, it could redefine the scale, but it also increase the complexity and execution risk. Hello everyone, I am CSIP George and this is Decoding Equity, where companies are analyzed through numbers and not by noise. If this analytical breakdown adds value, please consider subscribing. I publish structured research regularly for serious investors. Today we decode Adani Power. Quarterly revenue surged from rupees 7,700 crore in December 22 to nearly 15,000 crores in June 2024, driven by strong demand and favorable tariffs. Since then, the sales have moderated to 12,451 crore. The peak cycle has cooled, but the revenue remains structurally higher than the pre-financial year 23 levels. Operating margins expanded from around 19% in early financial year 23 to above 40% during the financial year 24 peak. Margins have since normalized to 34%, indicating the extraordinary phase has cooled, though efficiency remains stronger than earlier years. Quarterly net profit peaked at 8,759 crore in June 2023, supported by strong operations and elevated other income. Profits have since stabilized in the 2,500-3,500 crore range. The latest quarter at 2,488 crore reflects a more sustainable operating level. Adani Power has faced tariff-related and change in law cases common in the regulated thermal sector. These affect fuel cost recovery and margins. Regulatory exposure is part of the model but remains financially relevant. The company has incorporated Adani Atomic Energy Limited following policy changes permitting private participation in nuclear power. While this expands the long term optionality, nuclear projects are capital intensive and highly regulated. Execution and approvals will determine the impact. From financial year 21 to financial year 25, operating cash flow remained strong. In most years, cash from operation matched or exceeded the net profit. In financial year 25, while profit after tax moderated to 12,750 crore, cash from operation rose to 21,501 crore, indicating solid cash conversion and strong earnings quality. The balance sheet has strengthened materially. Debt equity reduced from nearly 4 times in FY21 to below 1 time in FY25, driven by profit growth. Despite a slight recent uptick, leverage remains far lower than the earlier years. Interest coverage improved from 1.4 times in FY21 to nearly 6 times in FY25 after peaking above 7 times in FY24. This reflects stronger profitability and improved debt servicing capacity. Even after moderation, coverage remains comfortable. Institutional holding patterns show shifting participation. FII ownership peaked at 17.5% in September 23 but declined to around 11.6%. Meanwhile, DAI participation increased steadily to 3.4% by December 2025. Promoter holding remains stable near 75%, indicating ownership continuity. In peer comparison, Adani Power trades at a PE of 24.3, broadly in line with the industry and similar to Torrent Power, but below Tata Power. Capital efficiency stands out, ROCE at 22.5% and ROE at 26.1%, higher than most of the major peers. Among key players, it combines sector average valuation with relatively strong return metrics. Overall, Adani Power has transitioned from a stressed balance sheet to a stronger financial position. Revenues remain elevated, margins have normalized, leverage has reduced, and cash generation is robust. However, earnings remain sensitive to tariff cycles, fuel dynamics, and regulatory decisions. The numbers indicate stability at a higher base. Future performance will depend on disciplined capital allocation, regulatory clarity, and sustainable profitability beyond peak cycles. This analysis is for educational purpose only and should not be considered as investment advice or a recommendation to buy or sell any security. This is CSAP George and this is Decoding Equity signing off. See you in the next analysis. Thank you.